Good afternoon. Maybe we'll give this a few minutes for people to join and then we'll start. We'll just give it one more minute. I see there's a lot more people still joining us. All right, well, good afternoon. Thank you for joining us today for our webinar on the One Big Beautiful Act that was signed into law on July 4th. My name is Lisa Goldman, and I am the practice leader of the International Tax here at Sachs. And Carrie, Lou, and I are excited to be able to tell you certain provisions that were included in this tax bill. The tax bill impacted both businesses and individuals, offering new opportunities across various industries and sectors. And we're excited to kind of explain it and do our best in terms of telling you how it may affect you and your business. The disclaimer, our firm provides the information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. Okay, now we can begin. We're very pleased to be able to offer this webinar to you. We're going to focus on three aspects of the bill: those that affect individual taxation, business taxation, and some cross-border or international tax provisions. The seminar will, if we can go to the next slide, the seminar qualifies for CPE credit. There's a QR code on almost every slide in the presentation. When a polling question comes up, please scan the QR code from your phone and you should be able to respond easily. Please put a question in the chat if you're having any difficulty. In order to receive CPE credit, you must be logged in for at least 50 minutes and complete more than half of the polling questions. You should get your certificate within 3 to 5 days. If you have any issues, and this email address will be at the end of the presentation also, please email us at training@sacsllp.com. So let's begin the webinar. We're going to start with the poll question. What date was the One Big Beautiful Bill Act signed? It's a hard thing to say, but I think we're going to launch that poll. So July 1st, July 2nd, July 3rd, or July 4th? Great. Well, almost was 69%. Got it right. But it was signed on July 4th, just this month. So I'm gonna kick it over to Lou, who's gonna talk about the individual tax provisions. So take it away, Lou.
Thanks, Lisa. Thanks, everybody, for joining. I'm Lou Calamunci, a tax director here, and I work in the PCS group and tax controversies. And we're going to discuss the individual provisions on the One Big Beautiful Bill Act. So first slide up, we're just going to go through the tax rates. So the current law and the new law going forward, they're the same rates. There's no changes. It's going to be 7 tax brackets, 10% all the way up through 37%. Same rates, no change on that. Standard deduction. So going forward, we're going to have the increase in the standard deduction pre-TCJA, Tax Cuts and Jobs Act. It was set to go back to 7,000, give or take, for inflation for single, but it's going to remain in the $15,000 range going forward. So this year it's going to be 15,700 for a single taxpayer and 31,500 for a married filing joint for your standard deduction. Prior, there were personal exemptions. Those have been eliminated permanently, so there's no personal exemptions. You used to get exemptions for yourself if you have any children that you were claiming. So the old tax law, you're getting them for the past 4 or 5 years. We were not getting them, and that's a permanent change in the tax code. No more exemptions. And then just keep in mind, I'm going to be saying permanent and sunset a lot throughout the presentation. What does permanent mean? Does it mean forever? Yes and no. It's just really until it gets changed again. So until there's new tax updates or tax laws. But for that, there are no more personal tax exemptions on your tax return. All right, next up, we're going to go over the state and local taxes. So currently, you're maxed out at $10,000. With the new tax bill, they're raising that to a $40,000 deduction. As long as your income is under $500,000, you can deduct up to $40,000 of state and local taxes. There is a phase out of 30% for any income above 500,000. So between 500 and 600,000, there's a phase out. It's at 30%. I have on the example all the way at the bottom, the last bullet. So if you have $550,000 worth of income, minus the 500,000, you're 50,000 above the threshold at 30%. So it's $15,000 reduction. So if you have 550,000 of taxable income, your SALT deduction would be $25,000. A couple other things in regards to that. Your SALT deduction cannot go below $10,000. So if your income's above $600,000, you're going to be able to deduct the $10,000. It increases each year by 1%. And this is not a permanent thing. This sunsets at the end of 2029. So it goes back to on January 1st, 2030, it goes back to $10,000. So this is just a provision in the tax code that they added that is going to go back to the $10,000 going forward in 2030. And then it's going to get adjusted the next couple of years for inflation. And then in 2027, they're going to increase the SALT deduction by 1%. This is just something I'm just going to touch on quickly. There's the SALT, there's the PTET workaround that the businesses take, or the beta election or PTET. In some of the prior draft bills that they had, the House bill, they're going to eliminate it, or they're going to eliminate the workaround. There is no elimination. You could still make your PTET and BATE payments on the entity level, and you're still going to receive the full deduction on that going forward. So that did not change in this tax bill. Next up is the excess business loss. This was another thing that changed in the House bill, but then it went back to the old way. So in the House, the original draft of the bill, they're going to eliminate how it was going to carry over. Now there's really no change to this. This is your losses are going to be limited still in year 1, but year 2 they're going to carry over as an NOL. Prior to that, they wanted it to carry over as an excess business loss, and it was going to eliminate your usage of how you could use this in year 2. So this is one of those other things that is going to be permanent. It was set to sunset December 31st, 2028. But this is a permanent provision in the tax bill. And then the excess business losses will be carried over as NOLs. And just for 2025, the max loss you could deduct from the current year loss is $626,000. If you have losses above that from a trade or business, it's going to carry over as an NOL to the following year. All right, next up is no tax on tips. So this is one of the things that actually goes into effect this year for 2025. So if you're a tipped employee, you are going to receive this deduction on your tax return, and it goes all the way through 2028. So this is for employees, and self-employed individuals may deduct qualified tips. Qualified tips are cash tips and charge tips. So the IRS did issue guidelines on this in on the next couple of slides. So FS 2025-03, the IRS did come out with guidelines. And then like the rules, it doesn't really say charge tips. There's always questions of if a credit card tip, can you deduct it? This one it clearly says charge tips from customers or tip sharing. Self-employed individuals are eligible for this, such as your rideshare drivers and stuff can deduct the tips that they receive. The maximum annual deduction is $25,000. And it phases out for if you have modified adjusted gross income over 150,000 for single taxpayers, or 300,000 if you're filing a joint tax return. This is a above the line deduction, so you don't have to itemize to deduct this. Self-employed, like I said, individuals are eligible if they receive tips, but SSTB are not non-eligible. And then the IRS did say by October 2nd, 2025, they're going to publish a list of occupants that customarily and regularly receive tips. So we get clarity on who really does that, if it's just restaurant workers, and how far can you extend this for tip employees. So we'll look forward to that later on in the year when the IRS issues guidance on who qualifies for that. Next up is another big one, no tax on overtime. So there's another provision in the tax code that the IRS actually did issue guidance on already. So this is for, so currently, obviously, overtime and all your wages are taxable. With the new tax bill starting this year in 2025, and this goes through all the way through 2028, a portion of your overtime is not taxable. So qualified overtime compensation that exceeds your regular rate of pay is non-taxable. So I'll give you an example. If you make $20 an hour, your overtime rate is $30 an hour. The $30 is not all tax exempt, only the $10 to split between your ordinary rate and the increase. So the half pay is exempt from taxable income. It is still subject to employment taxes. And this is going to follow the Fair Labor Standards Act, FLSA. So the maximum deduction you could take for a married taxpayer is $25,000, and for a single taxpayer is $12,500. And then there are all phase outs on this as well, $150,000 for a single taxpayer and $300,000 for filing a joint tax return. Employers are required to file information returns with the IRS showing how much overtime pay you received. And these overtime wages are not excluded from payroll taxes. So the employee and the employer are responsible for both sides of the employment tax on the overtime rate of pay as well. And this is another thing you don't have, this is going to be an above the line deduction, so you don't have to itemize for this as well to get this. Another one that has no tax on car loans. So this is really just saying that you could deduct the interest on your car loans. There are some rules to this. So an individual may deduct interest paid on a car used for the purchase of a qualified vehicle. The vehicle has to be a personal use, and leases do not qualify. If it's a business car, it doesn't qualify, but those have their own deduction rules for deducting on the business side. But if it's an individual buying a car, you could deduct the interest. The max deduction is $10,000. There are income phase outs of $100,000 for single or $200,000 for joint. The qualified interest what is qualifying interest? It's interest paid on a loan that was originated after 12/31/2024. It was used to purchase a vehicle for personal use, and the loan is secured by the vehicle. The qualified vehicle has to be a car, minivan, van, SUV, or pickup truck, or motorcycle with a gross weight less than 14,000 pounds. And this is another one you don't have to itemize to take this. So it's an above the line deduction. And the IRS did come out with guidelines on this as well of all the cars that qualify. And I don't think I added that real quick. It has to be manufactured in the US to get the final assembly has to be in the United States to qualify for this. Sorry about that. Next slide, we have a polling question. What was the SALT deduction cap increase to? 10,000, 25,000, 40,000, or 50,000? I'm just looking at some of the questions in the poll. In the Q&A, we'll get to those if there's time in the end. Some people are putting the answers to the poll question in there. You have to put you have to scan the code in the bottom, and a thing's going to pop up, and you have to answer the questions on your phone. So what was the SALT cap? Increase to 40,000 was the increase. That's the max deduction you could take. And obviously income limitations do apply. Okay, next up, we have the senior deduction. You may hear this saying no tax on Social Security and stuff like that. That's not necessarily true. Social Security is still taxable. This is just a senior deduction. So current law, there is no deduction. You just get with the One Big Beautiful Bill, it provides a $6,000 deduction or $12,000 for married couples where both spouses qualify. The deduction does have a phase out for single taxpayers of 75,000 and married for 150,000. To qualify, you have to be 65 years or older before the end of the year. And this is effective for 2025. So if you are over the age of 65, you will get this additional deduction, and it sunsets 12/31/2028. So this is what, so Social Security is still taxable up until 85% of the gross Social Security amount, depending on your income. They will receive an additional $6,000 deduction, and this is above the line deduction as well, where you do not need to itemize to take advantage of this. Okay, next up is gift tax. So it was set to sunset at the end of the year to go back to the pre-Tax Cuts and Jobs Act of 2017. Roughly, your exemption was going to be $5.5 million. But they are going forward, next year starting in 2026, your exclusion is going to be $15 million, and it's going to be adjusted annually for inflation. So that was one of the big things that was set to sunset and stuff like that. So they are going to keep the increased amount going forward. Another thing that would change in the bill was the child tax credit. So that's going to be increased to $2,200 per child. Other dependents that you claim, you'll get a $500 credit for that. There are phase outs, $200,000 for single, $400,000 for married. This is one of the permanent changes in the tax bill, and it's effective for 1/1/2025. So if you have children and you make under those amounts, you will receive the increase in the child tax credit. Next up, we're going to go over some itemized deductions. So charitable contributions, if you do not itemize, typically you can't take charity because you're not itemizing. This is going to allow you to take $1,000 above the line for single taxpayers or $2,000 for married taxpayers. So there is benefits for taxpayers to make charitable contributions. Even if you do not itemize, you will get some benefit up until $1,000 or $2,000. For the taxpayers that do itemize, there is a floor of 0.5% or 0.5%. So your charitable contributions will be limited on your charity. And this is another thing that's going to be effective of 1/1/2025 for the above the line deductions for the charity. A couple other updates on the itemized deductions. There used to be 2% deductions. Those have been permanently eliminated. They were eliminated for the Tax Cuts and Jobs Act, and then the One Big Beautiful Bill permanently eliminated them. For high income taxpayers in the 37% tax bracket, there used to be the PEAS deduction. Now it's kind of being replaced with a new limitation on it. It's going to be 2/37%, and your deductions are going to be eliminated. It's going to be the amount of the itemized deductions or the amount of the adjustable taxable income above the 37% tax bracket. So there's going to be a work paper that has to be filled out with your tax return, and your itemized deductions may be limited for high income taxpayers. And this is something that's not going to go into effect until next year. So January 1st, 2026. So it's not going to affect your 2025 tax return for itemized deduction limitations. Mortgage interest deduction. So it's really, that didn't really change, just the principal limit on mortgage debt is $750,000. If you have debt above that, it's going to be limited based off of ratios and stuff like that. And the other thing with mortgages, mortgage insurance premiums are now deductible. There are income limitations for that as well. So that was not deductible, but now they are going to be deductible going forward. Couple other updates on here for so personal casualty losses, same thing. You're not going to be able to make take personal casualty or theft losses any longer going forward. So it makes that that's a permanent thing, unless it's in a federal declared disaster area. Different story. You'll be able to deduct those losses and stuff. Another update on qualified business income. Carrie is going to go into it a little more detail on the business side, but the 20% deduction is going to remain going forward. So it permanently extends the 20% deduction for qualified business income. They did increase the phase outs. So it used to be between 50 and 100,000 it would phase out, depending on if you had UBIA or W-2 wages or if you're SSTB. Now they increased it to 100 to 150,000. So they increased the phase out on it. And everybody you're entitled to a minimum of $400 qualified business income deduction if you have $1,000 of income. So that's that, and that's effective next year, 1/1/2026. Next up is the Trump accounts. So this is just a savings account that was included in the bill. It's for children under the age of 18. It allows parents or whoever to deduct up to $5,000 a year into a tax-exempt Trump account. There's going to be a one-time $1,000 credit will be provided to each child born after December 31st, 2024, and before December 31st, 2028. If you make any contributions to this account, it's going to, the contributions are non-deductible. Similar to a Roth, they have a lot of similarities and stuff like that. Couple things on the distributions. There are no distributions until the beneficiary reaches the age of 18. The contributions that you put into the account are withdrawn tax-free, but the earnings are subject to ordinary income tax on the withdrawal. And there are some provisions on there what you can and what you cannot withdraw for, such as education and first-time home buyers and stuff like that. So gambling losses. So this is something that there's a lot on the internet and stuff on about. So it says you can only deduct up to 90% of your losses. And what that means is if you have 100,000 of gambling winnings and 100,000 of losses, you can only deduct 90,000 of it. So you would have a $10,000 income event. It's not going to cancel it out. But if you have 200,000 of losses and 100,000 of income, you could deduct up into 180,000, but you're limited to your income. So if your losses far exceed the income, you can still deduct the full amount on that. Just wanted to touch base on some of the energy credits. A lot of them were repealed in this bill, or they're going to sunset relatively quick. So like for residential clean energy improvements to your house and stuff like that, they were originally supposed to go through 2034, but they're going to be repealed at the end of this year. So if you're thinking about doing energy efficient upgrades to the house, you should look into it before the end of the year because it's repealed. Same thing with the electric cars and stuff like that. It's going to be repealed after September 30th, 2025. So this year that is going away. There's going to be no credits for purchase of electric vehicles going forward. And just have another poll. What is the new child tax credit amount per child? The poll is going to close now. So 2,200 is the new child tax credit amount per child. Sweet. So that's it for me on the individuals. I'm going to pass it off to Carrie Boyton on the business provisions.
Thank you, Lou, and thank you to everybody for being here with us today to learn about the One Big Beautiful Bill Act. My name is Carrie Boyton. I'm a tax director here at Saks, specializing in the construction industry, and I'm going to be going over the business provisions today. One thing you may notice as I'm talking through these various provisions is that a lot of them are not necessarily new, and a lot of them were born from the Tax Cuts and Jobs Act. So let's go ahead and get started with the qualified business income deduction. This was a new code section 199A that was introduced with the Tax Cuts and Jobs Act. As you may remember, there was a permanent tax rate cut, for C corporations with the Tax Cuts and Jobs Act down to 21%. But the top individual rate did not get quite such a large cut, only down to 37%. So Code Section 199A was introduced as a way to provide a similar tax rate on qualified business income at a pass-through level. So this is relevant for those pass-through businesses, partnerships, and S corporations. And it was set to expire at the end of 2025. So the OBBB is coming in. It's making 199A a permanent deduction. It also increases the ability to qualify for the deduction by increasing some of the phase-out limitations. So this deduction is limited if you're a part of a specified service business, so that certain industries that is specified by the IRS. If you don't pay enough in W-2 wages, your deduction can be limited. And if you don't own enough qualified property, your deduction could be limited. And those limitations come into play when your income is at $50,000 if you're single and $100,000 if you're married filing jointly. But effective for tax years after 2025, so 1/1/2026, those limitations are being increased to $75,000 if you're single and $150,000 if you're married filing jointly. So more taxpayers should be able to take advantage of this deduction. They also introduced a completely new piece of this code section, which is related to the minimum $400 deduction. if you have active qualified business income of at least $1,000. So that little active piece is completely new to this code section. It's actually bringing in language from another code section, 469. So this qualified business income has to be, you have to materially participate in the business. It can't be considered passive income to qualify. And again, these rules are effective for tax years after 12/31/2025. So this will not affect your 2025 tax return. This will start to affect your tax return in 2026. All right, another big hot topic coming out of Tax Cuts and Jobs Act was research and development. So let me give you a little bit of history as it relates to research and development deductions. Before the Tax Cuts and Jobs Act, taxpayers could generally choose what their accounting method for research and development expenditures was going to be. So you could choose whether or not you wanted to capitalize those expenditures and amortize those over time, or if you wanted to immediately expense those costs as they were incurred. That was your choice as the taxpayer. And if you elected to take the R&D credit, you could choose to either treat the credit amount as a non-deductible expense, offsetting your otherwise deductible R&D costs, or you could elect under Code Section 280C to take a reduced R&D credit. So the Tax Cuts and Jobs Act gets passed, no changes right away, but on the tail end, tax year 2022, the Tax Cuts and Jobs Act actually required capitalization of R&D expenditures. So the choice of the taxpayer to choose your accounting method was no longer relevant, and the IRS said you have to capitalize your R&D expenditures. And if it was a domestic R&D, meaning R&D done in the United States, then you got to amortize that amount over 60 months. And if it was foreign research, then you had to amortize over 15 years. They also got rid of the 280C election, and your R&D credit amount reduced potentially some of those capitalized costs. So now with the OBBB, well, just to back up just slightly, you can imagine, that sudden switch to, being able to deduct all your R&D to then having to capitalize and having no choice created quite a stir and created quite some operational issues, especially amongst the startup community and grant-funded research, where you have to use those grant funds exactly, how they're specified. You can't just go out and use them to pay taxes, because now you have to capitalize your R&D. So created a lot of problems. So luckily the OBBB came in and fixed those problems. So effective for tax year 2025 and the tax year we are currently in, we are back to pre-Tax Cuts and Jobs Act rules as it relates to domestic R&D. So now taxpayers can go back and they can choose, do we want to capitalize and amortize these costs? Do we want to expense these costs as they're incurred? For foreign R&D, you're still under the Tax Cuts and Jobs Act rules. So you would still have to capitalize and amortize over 15 years for any foreign R&D. So then you may ask, well, what do we do with 22 to 2024, right? We have all these costs capitalized. So there's a couple of fixes for that. All taxpayers, regardless of size, can choose to deduct the remaining expenses from 2022 to 2024 over the next 1 to 2 year period. If you're a small business under 448C, the gross receipts test, then you actually are allowed to go back and amend those years, 2022 to 2024, to expense the R&D and get immediate refunds related to those deductions. There is a timeline, however, so if you want to go back and amend those returns, you have to do that before a year is up. So by next, July 4th, 2026, those amended returns have to be filed. If you amend those returns, that 280C election is back in place. Otherwise, going forward, 280C is gone, and those expenditures for R&D, for the R&D credit, is going to be treated as non-deductible. Okay, so another new code section born from the Tax Cuts and Jobs Act is 163J. This is the interest deduction limitation. So again, with a little history, before Tax Cuts and Jobs Act, there was no limitation to the deduction of business interest. Tax Cuts and Jobs Act, we have 163J, which limits the business interest deduction for certain taxpayers. So certain small taxpayers, or if you're not considered a tax shelter, were not necessarily impacted by this. But if you were over the 448C gross receipts test, or you're considered a tax shelter, then you did fall under 163J, and your business interest was potentially going to be limited. Certain businesses could choose to elect out, real property and farming businesses, and the deduction, or the limitation, excuse me, of business interest did not include floor plan interest. And the way that the limitation was calculated was you had to first get to what's called adjusted taxable income. Then you would apply 30% to that adjusted taxable income number. And that's the amount that was limited. So for example, if you had $100,000 of adjusted taxable income, then you would be allowed to take as a deduction up to $30,000 of business interest. Any disallowed interest can be carried forward to a future period and included in that calculation again. So for Tax Cuts and Jobs Act, at first, the calculation for adjusted taxable income, it was your earnings before interest, taxes, depreciation, and amortization. So if you had big depreciation deductions, because you purchased a lot of equipment or something like that and took bonus depreciation, you could add that back. That was definitely taxpayer favorable. Unfortunately, in 2022, the add back for depreciation, amortization, and depletion was taken away from the definition of adjusted taxable income. So now those taxpayers who have gone out and made capital investments in their business and they're taking large depreciation deductions, they may have disallowed interest deductions because you can't add that back any longer. So moving on to our new bill, the OBBB, the definition of adjusted taxable income is reverting back to the earnings before interest, taxes, depreciation, amortization, depletion. So now you will be able to add back those depreciation deductions, which is good news. They also expanded the floor plan interest definition to include certain trailers and campers. And this is effective for tax years beginning after 12/31/24. So this is effective for our current tax year. Effective for the next tax year beginning after 12/31/2025, another new update to this code section is that the interest limitation calculation is going to include capitalized interest. So if you're required under, the most common would be 263 Cap A, but any code sections to capitalize interest, unless they are the 263Gs related to straddle contracts, or 263 Cap A small f, self-constructed assets, then you will have to include that interest also into your calculation. And any allowed interest is first applied to the capitalized interest, not necessarily your deductible interest. Any disallowed interest carried forward is not going to be required to be capitalized in a future year. So you don't have to necessarily track the two different types of interest separately on an ongoing basis. Once you're allowed to take the deductible interest on the carry forward amount, you would take that as an immediate deduction. All right, so moving right along, bonus depreciation. So with the Tax Cuts and Jobs Act, well, let me step back. Bonus depreciation is not necessarily new in terms of Tax Cuts and Jobs Act. This had been around for quite some time. But what was relatively new with Tax Cuts and Jobs was allowing 100% bonus depreciation. That was pretty exciting for a lot of business owners that were looking to invest, in their businesses with equipment and things like that. So once the Tax Cuts and Jobs Act was enacted through 2022, you were allowed to take 100% bonus depreciation. But then that started phasing down as time went on. And you can see now in 2025, we're at 40% bonus depreciation. So the OBBB came in and they made bonus depreciation at 100% a permanent deduction, which is pretty exciting. However, there's a small asterisk there. This only applies to property that was acquired and placed in service after January 19th, 2025. So we do have a small window, a couple weeks in January, where if you did place, you purchased property and placed it in service before January 19th, then you are still subject to the 40% bonus depreciation factor. All right, another exciting expansion of bonus depreciation is the allowance of bonus depreciation on real property. And this is really exciting because it's converting a 39-year deduction into an immediate deduction. Now, there are very specific rules related to this deduction that you'll have to, be careful with if you think this applies to you, because it has to be related to qualified production property. So qualified production property is property that's used to manufacture, produce, or refine tangible personal property in the United States. And there has to be a substantial transformation of that property in the United States. It also relates to, food and beverages. If you sell your food and beverages in the same building that you're, producing them, then this would not qualify. But that could be a really great planning opportunity if you're looking to expand your business, and maybe open a warehouse for the production side, and then you have your retail location separately. So like I said, you have to use the property to specifically for the manufacturing and production and refinement. So if you share, the facility with your admin team, with your sales team, with the R&D team, then you'll have to carve out those spaces because that would not qualify. There's also very specific rules related to the construction or the acquisition of the property. So the construction, it must begin between January 19th, 2025 and January 1st of 2029. And you have to place it in service within that 2-year period before January 1st, 2031. If you're acquiring the property and you're not building it out yourself, then you have to acquire it between January 19th, 2025 and January 1st, 2029. And there's another caveat that this property cannot have been used in a qualified production activity between January 1st, 2021 and May 12th, 2025. The original use has to be with the taxpayer. So you can see like they're wanting people to go out, construct new properties, acquire brand new properties. They're really looking for investment in the economy. This does not apply to lessors. So if you're a commercial lessor and you rent to a manufacturing tenant, unfortunately, you cannot look through to the lessor's activities and qualify it for this deduction. So, and if the property use changes within 10 years, there's going to be ordinary income recapture on all that depreciation that was taken. So they're trying to incentivize to go out, construct a new manufacturing facility, keep it in service for at least 10 years, and boost our economy. So you can see because of this expanded bonus depreciation and the potential to convert a 39-year potentially deduction into an immediate 1-year deduction, this is going to enhance the value of cost segregation studies. And if you're not familiar with what a cost segregation study is, it's basically where a team of professionals come in to your facility and they determine what aspects of your facility, what costs would qualify for these accelerated depreciation options. And if you think that that's something, that would be relevant for you and for your company, let us know because we have an amazing team here that can do those for you. Okay, so continuing on with accelerated depreciation, we also, in addition to bonus depreciation, we also have Section 179 deduction. And the OBB basically doubled the amount of deduction that can be taken. So for our current tax year, we were at 1.25 million that would be deductible under Tax Cuts and Jobs Act. And now under OBBB, that's doubled to 2.5 million. And they also expanded the phase out for acquisitions to $4 million. So as long as you have overall taxable income, you have, your purchases are at or below 4 million, then you would theoretically be able to take the 179 deduction up to that 2.5 million allowed. Now, all things considered, because of the increase in bonus depreciation to 100% and the additional limitation on Section 179, of overall taxable income. I'm guessing we'll see a lot more bonus depreciation, even though the 179 has been expanded. But it does leave a lot of room for planning as it relates to state implications, because as many of you know, states may or may not allow one or the other between bonus depreciation and Section 179. Okay, so moving over to the business meals deduction. This one kind of snuck in here a little bit. So let me kind of go over the history. So pre-Tax Cuts and Jobs Act, there was 100% deduction allowed for meals provided at the convenience of the employer if it was deemed de minimis. So, you know, think about kind of like your kitchens in the office with your snack bars and things like that that employers will offer. I feel like these got really popular with Meta, Facebook, and Google, you know, offering those big cafeteria style employee options. So for the Tax Cuts and Jobs Act, they changed that and made it a 50% deduction through the end of 2025, which is our current tax year, of course. And then for tax years after 2025, per the Tax Cuts and Jobs Act, that deduction goes away completely. So there's no deduction anymore for expenses related to and meals at an employer provided dining facility or at the convenience of the employer. So again, kind of think about those in-office kitchen type situations or snack bars, you know, things like that. So what the OBBB did is they provided some relief. You're going to see it's not, you know, it's not full coverage, but it did impact heavily the restaurant industry, where it's very common as an employee benefit to provide meals. And so the OBBB says, okay, if you maintain a full service kitchen for sale to your customers, then we're going to let you take the deduction for the meals provided to your employees as well. There's also a 100% deduction for food or beverage provided to certain crew members on certain fishing vessels in Alaska, oil and gas rigs, and certain fish processing facilities. So their lobbyists were out working hard for them. And this is going to be effective for tax years beginning after 12/31/2025. Okay. Okay, the Employee Retention Tax Credit, ERC. So I think, you know, this one has made the news quite a bit because of the massive amounts of fraud that's been caught related to this program that came out of the COVID era, you know, to try to help those employers who were keeping on their employees, even though they were seeing a reduction, you know, in their revenues. So because of all the fraud that's been happening, basically, the program has been retroactively terminated for any taxpayers who filed claims after January 31st, 2024. And they also increased penalties for the ERC promoters and increased the statute of limitations to 6 years. All right, and we're going to dive into another poll. Who signed the One Big Beautiful Bill Act into law? Was it Vice President J.D. Vance or President Donald Trump? And just a reminder, if anybody out there is having any issues related to the polling or CPE, don't forget to reach out to training@sacsllp.com. Got about 15 more seconds on the poll. Oh, 5 more seconds. About to close it up. All right, and the poll's locked. We almost got there. We almost got to 100%, 96%. I'm going to guess that some people just clicked the first option because you assumed the president would be listed first. And so we all really got 100% there. All right, very good. Very good. So we'll keep moving along. All right, so the next section we're going to discuss is opportunity zones. And this was a really cool program introduced with the Tax Cuts and Jobs Act. Some of you may have been familiar with, the 1031 options, like kind of exchange, things like that. And generally speaking, you always had to contribute all the proceeds you received, right, out of the sale for that to work. But in this case, with Opportunity Zone funds, you actually only had to invest the capital gains, which was pretty exciting, not the whole sales proceeds that you received, to be able to defer capital gains. So the way the program worked originally, you would invest your capital gains. You would be able to defer that capital gain until the earlier of 12/31/2026 or the sale of the Qualified Opportunity Zone Fund. If you held your investment for at least 5 years, you got to permanently eliminate 10% of your gain. If you held it for 7 years, you were able to permanently eliminate 15%. And if you held it for at least 10 years, then you had a complete reduction of your gain by 100%. So that was pretty exciting. And that expires 12/31/2028. So what the OBBB did is they came in and they made the Qualified Opportunity Zone Fund program a permanent program on a rolling 10-year basis that would start January 1st, 2027. And the way that the new program works is that any gains invested in a Qualified Opportunity Fund after 12/31/2026, when the new program starts, those gains would be recognized on the date, which is 5 years after the date of your investment in the Qualified Opportunity Fund. If you hold your investment for at least 5 years, then you get a permanent reduction of 10%. You can see they eliminated that 7-year 15% reduction. But if you hold for at least 10 years, you still get that permanent 100% reduction. They did add on one other layer here, though. If your Opportunity Zone Fund is just an amazing investment, something you really want to hold on to, once you hit that 30-year mark, you get your basis step up then. So theoretically, I guess it's not a permanent reduction. You would get your basis step up then, and then it would continue to, hopefully appreciate over time. Okay, the next provision we're going to be discussing is the Qualified Small Business Stock. So if you're not really familiar with what the Qualified Small Business Stock is, it's a specific code section 1202 that applies to domestic C corporation stock. Over 80% of your assets have to be used in active trades or businesses. And whoever purchases stock, cannot be another corporation. You have to be a non-corporate taxpayer acquired on original issuance. And so if that applies for you historically, you can see here, if you had acquired your stock prior to September 28th, 2010, there were up to a 75% exclusion. Depending on when you purchased your stock, you could either exclude up to 50% of your gain or 75% of your gain. And that was maxed out at $10 million or 10 times your basis. And then if you acquired that stock after September 28th, 2010, you got 100% exclusion as long as you held that stock for 5 years. Again, limited to the 10 million or 10 times your basis, whichever is higher. Well, OBBB came in and they kind of added some additional layers here. So now, if you purchase stock after the date of enactment, if you hold for that full 5 years, you still get 100% exclusion, but you don't have to hold it for 5 years anymore to benefit. So if you hold for at least 3 years, you can exclude up to 50%. If you hold for 4, 75%. They also increased the overall limitation from 10 million to 15 million. So that's pretty exciting. And then they also increased the eligibility limit on a corporation's assets. So to qualify, previously, the corporation that you bought into couldn't have more than 50 million in total assets. Now that's been increased to 75 million. So there will be more ability to invest in larger businesses. All right, so tip time to talk about tips. So on the business side, Lou already did a great job of talking about kind of how it's going to impact on the individual side, but of course businesses are going to be impacted too. So one piece related to tips is the expansion of the tip credit. So currently, as it stands, The restaurant industry can elect to claim a credit on their employer-paid FICA, that's the Medicare and Social Security, on tips that exceed their minimum wage. So with the OBBB, now the tip credit is being expanded to also include the beauty service industry. So, nail care, hair care, massages, all of those things. Those businesses that pay FICA on tips that exceed minimum wage would also be able to claim that tip credit now. And then I also just wanted to touch on the employer reporting requirements, because again, even though the actual deduction for tips or overtime is going to be taken at the individual level, the individual is going to need help from their employer or their 1099 issuer to understand how much they actually qualify to deduct. So that information is going to have to be reported by the employer or the payer of the 1099, and that guidance will be forthcoming from the IRS. All right. So another credit that is trying to benefit families for businesses is the paid family and medical leave credit. So as a part of the Tax Cuts and Jobs Act, there was a temporary credit enacted for 12.5% to 25% of wages for paid leave up to 12 weeks. Now, you had to have a written policy in place. It couldn't be discriminatory. You had to offer, at least 2 weeks of FMLA for full-time and pro rata for part-time. And then even if you offered all of that, to actually claim the credit, it had to be paid to a qualifying employee. So that's somebody who was at your business for at least a year and their wages didn't exceed 60% of HCE, highly comped employees. So for 2025, that amount is $96,000, just to kind of give you an idea of what that would mean. So what the OBBB is doing is it's permanently extending this credit. It's also expanding so that the employer can choose whether or not they want to claim wages or if they want to claim insurance premiums that cover the paid and family medical leave for the employee. Now, they did expand the written policy rules to include the controlled group rules. So all members of the controlled group have to have the written policy in place. So you can't kind of like pick and choose, which entities you're going to have these policies in place if they all fall under the controlled group rules. But they did also expand to include employer provided paid leave that's required by a state or local government that would count towards eligibility determination for the employer. Right, and another area that's kind of designed to try to help, fix some of the childcare issues that are happening right now in this country is the employer-provided childcare credit. So currently, there's a tax credit of up to $150,000 to help offset up to 25% of qualified childcare facility expenditures and 10% of qualified childcare expenditures. So this is, to try to help offset those costs if an employer actually opens up, childcare within their business themselves for their employees. And if anybody's a parent out there like me, childcare is hard to find. So I saw this and I definitely got excited that hopefully, parents out there are going to have more options soon, and businesses that choose to do this are going to have some great tax benefits. So what the OBBB does is they increase the credit amount from $150,000 to $500,000. They increase the credit percentage from 25% up to 40% of those qualified child care facility expenditures. They also expand the definition of qualified child care expenditures to include outside vendors and qualified child care facilities to include facilities that are jointly owned. So now you can see there's more options for employers to kind of, play around with this and potentially have a win-win solution for their employees and their taxes. Now, this is going to be effective for tax years after 12/31/2025. And there is a caveat for certain small businesses. You have to meet the 448C gross receipts test for the prior 5-year period, which is significantly different than any other 448C gross receipts test because that's typically a 3-year period. But if you do meet that test, then you actually can get up to 600,000 credit and your percentage of expenses goes up to 50%. So that's pretty amazing. All right, and then the last piece I was going to touch on is related to 1099 reporting, every business owner's favorite thing to do in January, of course. So this year, 2025, as hopefully those of you who are subject to 1099 reporting know, your threshold is $600 for 1099 NECs and 1099 miscellaneous. And that's going to be increasing to $2,000, getting effective for tax years beginning after 12/31/2025. So this year, still 600, next year, 2,000. And then 1099K reporting, this may even be more exciting for some people. The pre-ARPA thresholds are being reinstated retroactively. So those are going back to $20,000 and $200, or not $200, excuse me, 200 transactions. So I know there was some concern, that people were going to be getting 1099s all over the place from, Venmo and all different types of sources. So hopefully everybody can kind of breathe a sigh of relief with that. All right, so we're going to go into another poll question. Question is, are the clean energy tax incentives going away? Yes or no? And hopefully everybody remembers what Lou was talking about during his section in terms of individual clean energy tax incentives. This also does relate to the business energy tax incentives. If you are currently, utilizing any business energy tax incentives, or if you think any may apply to you, please reach out ASAP to your CPA so we can try to work with you and make sure you get any of these incentives before they expire. And we got about 15 seconds left on the poll. All right, about to close. All right. And most of us said yes, so I'll give it to you. All right, very good. Well, thank you again for your time today. That was a wrap on the business side. And I'm going to turn it over to Lisa Goldman to lead the way on the international provisions.
Thanks, Carrie. And it sounds like there's a lot of opportunities in the business area for increased deductions. So it should be an exciting planning year. So I'm going to focus on a couple things in the international tax area. Congress seemed to do some rebranding here, and they didn't rebrand as a marketing gimmick. They did it because they changed the way some things are being calculated, and the old names of the regimes didn't make sense, so they renamed them. So let's start with the first one. Now this is the things that I'd like to cover. The GILTI regime, want to go back. FDII revisions, foreign tax credit changes, BEAT changes. There's a new remittance excise tax, and then there's a few other, if we have time, other key international tax things that I'd like to cover. So we'll start with GILTI. So under prior law, under TCJA in 2017, the international tax, the taxation of international operations changed drastically in that instead of being able to defer your earnings in your foreign corporations, you now had to pay tax on the income as it was earned, not when it was distributed to the shareholders. And the name of this regime was called GILTI. And the way that it was calculated is that you took your income and you reduced it by this acronym called QBAI, which was 10% of your net asset value. So if you were a capital intensive business and had a lot of equipment, you may not have had to have any income inclusion. Under the new law, they took out this reduction of QBAI. So now it's just your tested income is what's being taxed. So because they could no longer call it GILTI, they now renamed it to net CFC tested income. And that's what's going to be taxed to you after it's calculated. And there's no QBAI deduction. So who this mainly affected were capital intensive businesses because they're now going to pay tax on all their CFC income, not just the income that was in excess of this net asset 10% threshold. And they were able to use this high QBAI threshold to offset other tested income, which is no longer available. And this change is effective for tax years beginning after 12/31/2025. So if we can go to the next slide, I'm going to just give a small example because sometimes these calculations get complex. So if we have a US parent that owns a low tax controlled foreign corporation with $100 of net income and $500 of QBAI, under the old law, they would pay tax if you're able to reduce your QBAI and you come up with net tested income of $50. Plus there's another deduction of half. So you'd only pay tax on $25 at 21%. Your tax would be $5.25. Under the new regime, you can't reduce your income by this $50. So you're paying tax at $100. And the 250 deduction, which I'm going to discuss in just a minute, instead of being able to take half of it, you're only able to take 40% of it. So your taxable income is now $60 and your tax at 21% is 12.6%. So it actually increases the tax under the new regime. So the 250 deduction, the way that GILTI was calculated was you took your tested income, reduced it by 10% of your QBAI, and then you were able to reduce it again by 50% of it. In 2026, that 50% became 37.5%. What Congress did was they now took that deduction and it's now permanently for 40%. So the little chart here to kind of explain 2025 rates, what 2026 rates would have been under prior law, and now what the permanent 2026 and beyond rates are at 40%. The other thing that they changed under prior law, you were able to take a foreign tax credit on your taxes that you paid on your GILTI income, your tested income, but it was limited to only 80% of the taxes paid. So thus the effective rate was if you had effective GILTI income of over 13.125%, you wouldn't pay any tax after the foreign tax credit. Under the new law, instead of the 20% haircut, they reduced it to 10%. So 90% of your foreign taxes became creditable. So thus, no US tax on income subject to a 14% foreign tax rate. Additionally, they disallowed 10% of the foreign taxes on distributions of previously tax GILTI income. So it's effective for distributions made after June 28, 2025. And this is effective for tax years beginning after 12/31/2025. Again, I have another example because I threw out a lot of different percentages to you, and sometimes it's easier to see it once calculated. So let's go to that next slide. So again, if we assume foreign tax paid are equal to the US tax rate of 21%, or equal to the tax of at our tax rate, and we're ignoring QBAI. So if we have $100 of tested income in current law or prior law after our 250 deduction at 21% tax rate with the foreign tax haircut of the 10% instead of the 20%, our taxes actually go down to $1.26 in my example versus $2.10. And what this means is that, which is what I always tell my clients, we really need to run the numbers to kind of see what the effect of the changes in tax laws, to see what is advantageous for us, where our situation is going to be, and how to plan for the future. Another big change that occurred under calculating our GILTI income was the allocation of expenses. So under prior law, you had to apportion interest, R&D expenses, and administrative expenses between US income and foreign source income. Why this was important? This is the limitation, how the limitation is calculated to how much income could be allocable for the foreign tax credit. So it sometimes reduced your ability to take the foreign tax credit after you took up all these expense allocations. So under the new law, this is very favorable. There's only three things that will reduce your foreign source income. This increasing your limitation for foreign tax credit purposes and taking a greater foreign tax credit. The three things are the 250 deduction, your state and local taxes imposed on your tested income, and then any other deduction that is directly allocable to the tested income other than interest expense and R&D expense. So again, this is very favorable. first of all, it makes the calculation a lot easier. We don't have to do these big calculations and big spreadsheets. And second of all, as I mentioned before, we have a higher foreign tax credit limitation, so more ability to take foreign tax credit against our taxable income. And this again is effective for tax years beginning after 12/31/2025. So everything I mentioned before is current law as it applies to C corporations, but many of our clients don't operate in the C corp environment. They operate in the pass-through environment, or they directly own their controlled foreign corporations. So under current law and prior law, there's a code section called Section 962 that allows us to act like a C corporation, take advantage of the foreign tax credit, take advantage of the 250 deduction, and perhaps not pay tax on our income being earned in our foreign corporations. So what this means under the new law is that there may be more need because of the loss of the QBAI deduction, the 10% QBAI deduction, to look at 962 and take advantage of it for those clients that own their CFCs individually or through S corps or through partnerships. So this election may be utilized more. That I just wanted to mention as a planning idea. Okay, now I want to switch gears to another rebranding under the new tax law. What the old regime was called was the Foreign Derived Intangible Income Regime, or FDII as it was known. And now it's called the Foreign Derived Deduction Eligible Income, which is FDDEI. I'm not quite sure how people are going to pronounce it. But what FDII is, it's a US tax incentive that lets domestic C corporations pay a much lower effective tax rate on goods, services, or intellectual property being used or sold to foreign customers for foreign use. And under the prior law, it made the tax rate on these types of exports, instead of 21%, be taxed at a 13.125%, which was extremely favorable. And even after 2025, under the prior law, it took that tax rate up to 16.4% instead of 21%. So even though things were changing a little bit, it's still a very favorable tax rate. Under the new law, there were two changes. There was also this QBAI hurdle, which couldn't take the deduction if over 10% of your fixed assets. And it took that out. So you no longer have the QBAI hurdle. And in addition, it took this 250 deduction, which also applies in this calculation. Instead of being 37.5% or 21.875%, it's now permanently at 33.34%. So the short end of it is the effective rate on FDII income, or FDDEI income, is now 14%. So I have another example to kind of show how this works mathematically. So we'll go to that slide. So our assumption is that we have exports of $100, our allocable expenses are $50, our QBAI or net fixed assets are $300, and we're assuming no domestic sales, no loss carryforwards, no credits, no research and expenditure add backs, just basic. We're just exporting all of our revenue. Under the prior law, once you apply the 10% QBAI deduction and you take the 250 rate, so your deduction under the 250 deduction amount, and you apply the 21% tax, you'd pay US tax on $50 of exports of $2.63. Under the new law, again, we lost our QBAI deduction. Our 250 rate was adjusted a little bit. So our tax dollar is now going to be taxes owed on our example are now $7 instead of the $2.63 under the old law. So again, an effective rate, but it's still extremely favorable when US corporations export, again, goods, services, or intangibles overseas for foreign use. So it's a very good regime. It's something we always look for in our clients, that to make sure that we're taking advantage of this tax opportunity. So now I have a poll. And now FDII is now classified as foreign derived deduction eligible income, foreign derived income deduction, or newly derived foreign income deduction. And none of those are easy to say. But I want to mention, because it's coming up in the chat, the slides and the recording of the webinar will be available there will be a link to a website. It will be available after the webinar is over. So almost half of us got it right, foreign derived deduction eligible income, but I feel like that might be a tricked question because there's a lot of F's and D's and I's in the answers. So, so I want to take turntables now. Oh, I'm sorry. I want to talk about one other FDDEI change. It used to be under old law that gains from sales that, again, were exported of rental or royalty property were included in the FDII. They're now excluded, and it applies to any dispositions after June 16th, 2025. So what that means is that we just need to carefully track transactions that are included in mergers or acquisitions and any licensing structures. And the expense apportionment that I mentioned under GILTI or the CFC income regime is also been changed in terms of expense apportionment for foreign tax credit. You only have to reduce it by directly allocable expenses other than interest and R&D expenses. So this was also very favorable. I'm sorry, I want to talk briefly about BEAT adjustments. So BEAT applies in very specific situations to corporations that have annual gross receipts in excess of $500 million. It's a 3-year average. And if applicable, BEAT imposes an additional tax of 10% on modified taxable income that exceeds the regular tax liability. So it affects very large multinational corporations. Prior law, the BEAT rate was 10%. It's scheduled to rise to 12.5% 2026. It's now permanently at 10.5%, so that's favorable. But other regime things were kept in the BEAT. So R&D and other credits still can reduce your BEAT liability, and base erosion percentage tests and the credit ordering rules were retained. So this ended up being a better answer for R&D intensive company. So I just want to mention that. I want to turn tables to a new tax that was thought to be much worse than it ended up being. Under the House version, it was going to apply to a lot of people, individuals, and what came out in the final version, the teeth were actually taken out of it. What it is, it's a 1% excise tax on certain transfers of funds that a sender, an individual, whether they're under the proposed, it could have been anyone, but now it's only selected people, that a sender in the US sends to a recipient located in a foreign country, effective for any transfer after December 31st, 2025. The rate is 1% of the amount transferred. It applies to cash, money orders, cashier's checks, or other similar physical instruments. And the banks and MSBs would collect the tax. And if they don't collect it, they're liable for it. The tax is not creditable or deductible, so it's just an expense. But what was significantly changed in the final bill, which is on the next slide, is what's excluded. So the new law permits 2 exemptions. It doesn't apply to remittance transfers from accounts held in a financial institution insured by the FDIC, a commercial bank or trust company, a private banker, credit union, or broker-dealer registered with the SEC. So it's pretty expansive what's excluded. and it doesn't apply to remittance transfers using a US issued debit or credit card. So the point here is that this new law exists, but it's really limited in scope compared to the earlier proposals, as most transfers from accounts occur from US banks and financial institutions. So good news, but it's just something that now exists in tax law. There's 6 other international provisions I want to mention. There's a lot of news about this new revenge tax, Section 899 revenge tax, and it was removed from the final version. Why? Because there was a global agreement between us and our trading partners that they weren't going to do duplicative surtaxes on certain transactions, so we weren't going to impose this revenge tax. So that was good news. There was a very favorable fix to the sourcing of income from the sale of inventory produced in the U.S. It's going to increase our ability to take the foreign tax credit. Under prior law, sourcing of income was stemmed from the place of production, which if it was in the U.S., was very difficult to take a foreign tax credit on that income. Now, certain inventory that was otherwise subject to U.S. source because the production occurred in the U.S. will be treated as foreign source, meaning that we could take a foreign tax credit on that income if the person who's exporting the property maintains an office or other fixed place of business overseas. And the amount that is treated as a foreign source is limited to 50% of that income. But that's better than nothing. That's a very good change. Another big change is there was a CFC look-through rule that since 2005, it was a temporary rule that every other year, there was law being done in Congress to extend this temporary rule. And it was finally made permanent. So for a long time, for 20 years, we always had to make sure that this temporary rule was, again, either extended or maybe made permanent. And it's a CFC look-through rule. What it says is that if lower tiered CFC pay dividends or interest or rents up to a higher tier CFC, instead of it being taxable under our Subpart F rules, you can look through to the income of the lower tier, and if it's from operations, it won't be considered Subpart F. So again, a good fix. Another change that may affect some clients is that there used to be a 1-month deferral rule and that was repealed. What that means was that under tax rules, we're required for our controlled foreign corporations to have the same tax share as the majority of our U.S. shareholders. And what it permitted was to have a 1-month lag, meaning that you could have a 1-month difference in your tax year end. Now it says that 1-month lag can no longer apply, and your CFCs have to have the same tax year end as your parent. So that may require some year-end adjustments and some 1-month, fixes. Under TSGA, the Tax Jobs and TCJA Act, there was a repeal of 958B4. And what that did was it removed the downward attribution rules and made a lot of foreign-owned U.S. corporations in a structure that had brother, sister, foreign, entities, CFCs. It was very unfavorable. It caused a lot of additional reporting and a lot of uncertainty as to how this was going to be treated. That was restored. So now if you have a structure, there's no what they call downward attribution to your from your U.S. subsidiary to your foreign subsidiary. And that would eliminated unnecessary filings. So that was a great restoration. In its place, because there was some abuse seen as to why they repealed that, is they imposed this new section called 951 Cap B, and it said foreign controlled U.S. shareholders could be subject to Subpart F, and it's no longer guilty with the new regime, even when there's a foreign parent is non-U.S. And it was seen as abusive, so it's a new anti-abuse measure. Treasury will come out with some rules as to how this will work, so it's kind of in its infancy stage, but it now exists. And then I think the last thing I'm going to mention, because I think we're running out of time, is under the old rules, if you sold your CFC mid-year, you wouldn't have to include any GILTI or Subpart F if you weren't the shareholder on the last day of the year. It's now going to be prorated. So if you sold your CFC mid-year, you will have to pick up your prorated share of Subpart F or GILTI income, or the new GILTI tax regime income, for the portion of the year that you owned it. And this will be effective for taxable years beginning after 12/31/2025. And this is a summary of the key changes that I just discussed. Again, the slides will be available on a website that will be emailed to the participants after the webinar. So I think that concludes our webinar for today. I don't think we have time for questions, but I would encourage you to email any of us if you have any questions about any of our presentations. And here's our email addresses and our contact information. If there's any questions, please contact about the webinar not getting credit, please email training@sacsllp.com, and certificates will be made available within 3 to 5 days. I thank you for joining us on the webinar today. We enjoyed giving this presentation, and again, if you have questions, please reach out to us. Thank you.